Everywhere you look today, corporations are celebrating the same ritual. Press releases boast of record-breaking share repurchases. Investors cheer as companies announce billions in buybacks, confident that fewer shares mean greater value. But here's the paradox. If buybacks are meant to reward shareholders, why do so many of those same shareholders end up poorer when the market cycle turns? Why do so many companies, once praised for their capital discipline, find themselves over-leveraged, fragile, and unable to weather the next storm? Benjamin Graham, the father of value investing, would likely smile at the spectacle, not out of cynicism, but recognition. He had seen this before, the eternal dance between rational capital allocation and speculative illusion. And he would remind us that not every act dressed in the language of value creation truly creates value. In today's episode, we'll explore a question that cuts to the core of investing wisdom. How would Benjamin Graham judge modern corporate buybacks? By the end of this lesson, you'll know exactly how to separate the genuine from the deceptive, how to see through the noise of headlines and measure each buyback the way Graham would have, by its relationship to intrinsic value, margin of safety, and rational intent. Because in a world obsessed with appearances, Graham's discipline remains a mirror, revealing what's real and what is merely reflected light. And that's the quiet promise of this exploration. You will not just learn what buybacks are, but how to think about them, to judge them not by the confidence of management or the excitement of markets, but by the calm arithmetic of value. The deeper truth is this: a buyback is not an act of generosity, it is an act of judgment. It reveals what management truly believes about their company's worth and whether they are serving the shareholder or the share price. Graham taught that every financial decision carries within it a moral dimension, the difference between stewardship and speculation. Nearly a century later, that distinction has never been more urgent, because when a company buys back its own stock, it is making the most revealing statement possible, not in words, but in numbers. And as Graham might say, figures don't lie, but liars figure. In this video, we'll use Graham's timeless lens to uncover what's really happening behind modern buybacks, the incentives, the illusions, and the rare cases of true value creation. The markets may celebrate every announcement, but Graham would quietly ask, at what price and for whose benefit? To understand how Benjamin Graham would view modern corporate buybacks, we must first return to the era that shaped his thinking, an age when capital allocation was not a press release, but a test of prudence. In the 1920s, the market danced to the same tune we hear today: optimism, leverage, and almost a religious belief that rising prices confirmed intelligence. Companies issued new shares, split them, and manipulated earnings to keep up appearances. Then came 1929, and the music stopped. Graham lived through that silence. He saw what happened when corporations and investors mistook speculation for strategy. He watched companies destroy shareholder value, not because they lacked intelligence, but because they lacked discipline. When The Intelligent Investor was published decades later, the scars of that era had already become his lessons. Graham taught that the role of management was not to perform for the market, but to protect capital, to act as the rational custodian of shareholder interests.
In Graham's time, the preferred ways to return cash were clear and limited. Pay a steady dividend, reinvest wisely, or hold reserves for lean years. The idea of companies routinely buying back their own shares would have struck him as extraordinary, even suspicious, unless done under one condition: when the market had deeply undervalued the business. To Graham, such moments of mispricing were rare gifts, not marketing opportunities. He would have seen buybacks as legitimate only when driven by logic, not vanity, when they reduced the number of shares at a discount to intrinsic value, thereby enriching continuing shareholders. But as decades passed, that caution faded. By the 1980s, buybacks were no longer rare, they became fashionable. Management discovered that repurchases could boost earnings per share, support stock options, and even mask the dilution of executive compensation plans. The act that was once the mark of conservative management became a tool for corporate cosmetics. Today, we live in a market where trillions are spent each year on buybacks, often at prices Graham would have called dangerous. Companies use borrowed money to repurchase shares at record valuations, leaving little margin for safety. Investors, meanwhile, applaud, forgetting that the same applause once echoed through the halls of 1929. And yet, this is precisely why Graham's lens matters more than ever. Because his philosophy wasn't built for yesterday's market, it was built for human nature. And human nature hasn't changed. For Graham, capital allocation was a mirror of character. He would not have asked how much a company bought back, but why. And it's that why, the quiet, rational motive behind the numbers, that separates the investor from the speculator and the steward from the showman. For Benjamin Graham, every corporate action, every decision to reinvest, to pay dividends, or to repurchase shares came down to one question: does this increase intrinsic value per share? That was the ultimate test. Not whether Wall Street applauded, not whether the stock price jumped after the announcement, but whether each remaining shareholder was left owning a business that was truly worth more. This distinction may sound subtle, but it changes everything, because Graham drew a sharp line between value distribution and value destruction. A buyback funded by genuine surplus capital and executed below intrinsic value is a disciplined redistribution of wealth, a rational act of value creation. But a buyback done at inflated prices or financed through debt is something else entirely. It's the quiet destruction of shareholder value disguised as confidence. Graham's philosophy was built on what he called thorough analysis. He believed that all intelligent investment rests on measurement, on understanding what something is worth independent of what the market says. If management bought back shares at a price above that independent estimate of value, they were not acting as investors, they were speculating with shareholders' money. And that, to Graham, was a breach of duty. He often warned against the temptation to act for appearance rather than substance. He wrote, "The chief problem of the investor, and even more of the speculator, is likely to be himself." In corporate terms, that self manifests as managerial ego, the desire to display confidence, to play to the market, to equate rising prices with good judgment. But Graham knew better. He understood that rational capital allocation is not about timing, but about valuation. The moment a company begins to chase its own stock simply because the market approves, it has already abandoned the discipline of intrinsic worth.
He would have judged buybacks by three questions. 1. Is the company truly undervalued by objective analysis? 2. Is the capital used for buybacks genuinely surplus, not needed for operations, debt repayment, or reinvestment? And 3. Does the action strengthen the long-term interests of continuing shareholders? If the answer to all three was yes, the act was rational. If not, it was speculation, no matter how sophisticated the justification. To Graham, this wasn't just financial logic. It was ethical logic. Because every dollar of shareholder capital carries responsibility to preserve, to enhance, and never to gamble. And in that light, modern buybacks reveal themselves for what they truly are, not signals of strength, but tests of character. To apply Benjamin Graham's thinking to modern buybacks, we must return to the heart of his philosophy, the concept of intrinsic value and the principle that guards it, the margin of safety. Graham defined investment as an operation which, upon thorough analysis, promises safety of principal and a satisfactory return. Anything else, he said, is speculation. Now imagine applying that standard to the modern corporate buyback. When a company repurchases its own shares, it is effectively investing in itself. The question Graham would ask is simple. Would you buy your own stock at this price if you were an independent investor? If the honest answer is no, if the company's shares are trading above their intrinsic worth, then every dollar spent on buybacks is not investment, but speculation with shareholder funds. It reduces safety, not increases it. Graham's analytical method was grounded in arithmetic, not emotion. He taught that investors, and by extension managers, must rely on measurable facts, earnings power, asset values, financial strength, and stability of income. From these, one could estimate intrinsic value, not with false precision, but with disciplined reasoning. And it was from that calculation that the margin of safety emerged, the cushion between price and value that protects against error, emotion, and unforeseen change. In Graham's view, the greater the uncertainty, the larger that margin should be. Now consider how companies behave today. Many buy back shares when optimism is at its peak, when prices are far above any reasonable estimate of intrinsic value, and when debt is cheap. They justify the act as a return to shareholders, yet in truth they are returning nothing, merely exchanging real capital for inflated paper. Graham would have seen this as a violation of the margin of safety, a sign that management had traded judgment for fashion. He would have insisted that the true purpose of a buyback is not to signal confidence, but to allocate capital rationally only when the business is selling for less than it's worth. In his quiet, mathematical way, he would remind us, the function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. A company that buys its own shares with no safety margin is making a bet, not an investment. And when optimism fades, as it always does, the numbers reveal the truth that marketing once concealed. Through Graham's lens, then, a buyback is not a symbol of strength. It is a moment of truth, a test of whether management truly understands and respects the intrinsic value of the enterprise they are meant to protect. Look across today's financial landscape, and you'll see an extraordinary phenomenon. Corporate America has spent over $5 trillion on share buybacks in the past decade alone. For many companies, buybacks now exceed research, innovation, or capital expenditure. They've become the default expression of shareholder value. But as Benjamin Graham would remind us, the more something becomes fashionable, the more it demands skepticism.
Buybacks, in theory, reward shareholders. In practice, they often transfer value, not create it. They reward those selling their shares today, sometimes at the expense of those who remain tomorrow. And in an age where cheap money has fueled this ritual, Graham's warning against illusion feels prophetic. The essence of investment management is the management of risk, not the management of return. Let's examine this through the modern lens Graham would use. Over the past several years, companies have borrowed heavily to finance repurchases, turning balance sheets into fragile structures of confidence. They've boosted earnings per share, not by growing profits, but by shrinking the denominator, the number of shares outstanding.
Investors cheer the optics, but Graham would quietly ask, has intrinsic value increased, or has the illusion merely been magnified? He'd recognize the pattern immediately, the human tendency to mistake motion for progress. To him, buybacks conducted at inflated valuations are a form of self-deception, a corporate mirror trick. They make numbers appear stronger, while the foundation weakens underneath. Yet, Graham would not condemn all buybacks. He would admire those few companies that repurchase with restraint, using excess cash during pessimistic markets at prices below intrinsic worth. He would see in those decisions the mark of genuine investment intelligence. Berkshire Hathaway's disciplined repurchase policy, for instance, would earn his approval. Its rule to buy only when the stock trades below a conservatively estimated intrinsic value is pure Graham. It treats buybacks as value investments, not marketing gestures. But most modern buybacks are done in reverse, fueled by optimism, not analysis. Companies repurchase most aggressively when markets are euphoric and pause when prices fall. To Graham, this inversion of logic would reveal not discipline, but dependence, a form of psychological capture by the market itself. Nearly a century after his first writings, the pattern remains. Investors and corporations alike still confuse popularity with wisdom and activity with intelligence. Through Graham's lens, the trillion-dollar wave of buybacks is not a story of confidence, it's a reflection of our age-old struggle between reason and emotion, between arithmetic and applause. And as he would say, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. When the weighing begins, only true value will endure. At its core, the story of modern buybacks is not about finance, it's about character. Because behind every decision to spend billions repurchasing shares lies a deeper question. What kind of stewards are we of other people's capital? Benjamin Graham believed that investing was not merely a technical pursuit, it was a moral discipline. It demanded humility, honesty, and a deep respect for the boundaries of one's knowledge. When a company buys its stock at inflated prices, it's not just a misjudgment of value, it's a quiet betrayal of that discipline. Graham often said that the market, like human nature, oscillates between fear and greed. But within corporations, those same forces appear as vanity and fear of missing out. Executives repurchase shares not because they've calculated true value, but because they fear being left behind by peers, or they crave the illusion of control over price. In Graham's view, such behavior reveals a misunderstanding of purpose. He taught that the goal of business was not to excite shareholders, but to serve them, to treat their capital as something sacred, entrusted rather than owned. He would likely see today's impulsive buybacks as a form of moral inflation, where image outpaces integrity and short-term optics eclipse long-term stewardship. And as he would say,
there's a passage in The Intelligent Investor where Graham warns of the speculator's fatal confusion between price and value. That confusion, he'd argue, now exists not only among investors, but within the very companies they invest in. When management begins to view its own stock as an instrument to manipulate, rather than a reflection of enduring worth, the organization loses its anchor to reality. Through Graham's eyes, a responsible buyback, like a responsible investment, must embody three virtues: rationality, patience, and honesty. Rationality demands that decisions be grounded in analysis, not emotion. Patience ensures that timing serves value, not vanity. And honesty, the rarest of all, requires management to admit when the stock is too expensive to buy, even if the market clamors for action. In that sense, every buyback becomes a mirror of human nature. It reveals whether leadership acts from confidence in value or from anxiety about perception. It shows whether the company's heart beats with long-term prudence or short-term ambition. Graham would remind us that the ethics of value are simple but demanding: to act with reason when others are swept by emotion, to protect capital, not perform for applause, and to measure success not by what is celebrated, but by what endures. Because as he knew, markets forget, but value remembers. And in the end, the true test of integrity in both investing and leadership is whether one's actions remain sound when the noise fades. So how would Benjamin Graham want us to judge a modern buyback? Not by its announcement, not by its price action, but by its principle. He would offer a simple framework, a timeless checklist grounded in logic, not excitement. To Graham, a buyback passes the test of rationality only when it meets three conditions. 1. Price. The shares are clearly trading below their intrinsic value, offering a meaningful margin of safety. A repurchase at or above fair value is not investment. It's speculation, dressed in financial language. 2. Capital. The funds used are truly surplus, capital that cannot earn an adequate return within the business itself and is not needed for debt reduction or productive reinvestment. Using borrowed money for buybacks, especially at high prices, would have struck Graham as an act of dangerous self-deception. And 3. Purpose. The motive is rational and enduring, to increase value for continuing shareholders, not to inflate short-term metrics, placate analysts, or boost executive compensation. If any of these three fail, Graham would not rationalize the action. He would quietly write it off as speculation, the enemy of enduring wealth.
And perhaps that's the real wisdom here. Discipline is not in what we buy, but in why we buy. The same is true for companies as for investors. Graham's philosophy reminds us that capital allocation is an active philosophy disguised as finance. Every dollar a company spends reveals what it truly values: patience or pride, stewardship or spectacle. When managements treat capital as sacred, their decisions echo with the clarity of purpose that outlasts market noise. When they don't, even billions can vanish into illusion. For the thoughtful investor, this is where Graham's voice still guides us. Don't be seduced by buyback headlines. Look beneath them. Ask the same questions he would have asked. What is the intrinsic value? What is the motive? What is the margin of safety? In a world where financial engineering often masquerades as financial intelligence, remembering these questions is an act of independence, a quiet form of resistance against the culture of noise. Graham taught that investing was, above all, a temperament, the ability to stay rational when others are not. That temperament applies not only to our portfolios, but to how we judge the actions of those who manage our capital. So when the next buyback is announced with bold headlines and market cheers, pause for a moment and look through the Graham lens. Ask not what the market feels, but what the numbers and motives reveal. Because in the long run, only one thing survives the cycles of illusion and applause: value, quietly, patiently, and rationally created. And as always,
Subscribe and join us in keeping Benjamin Graham's wisdom alive, one lesson at a time, for a world that still needs rational investing.